Hello, traders. Because of income coming to you from theclosingprint.com, Sunday, the 30th of March, 2025. In this edition of your weekend video newsletter, we'll discuss the indices which closed down markedly on Friday on 16 to 1 down volume on the Qs and 6 to 1 down volume on the NYSE, the NASDAQ Composite, and the Spiders. This negative breadth and market weakness leaves us with two bullish indicators for the week, 4 neutral and the majority bearish at 14. That said, there are huge positive gamma strikes at 55.60 through 55.75 as support, with the JPM collar expiring and rolling on Monday. The Qs saw 15 to 1 down volume on Friday, with the remaining indices near 6 to 1 or greater. This leaves us with the S&P 500 in a bearish bias starting Monday trading, with support at a very large positive gamma strike between 55.60 55.75, aligning with the JPM collar, which rolls on Monday. That said, momentum is clearly bearish, with MACD, stochastics, and RSI all turning lower, with volatility picking up again on Wednesday through Friday, closing near 22, leaving traders and investors scrambling as breadth deteriorates across the S&P 500, mid-cap, small caps, and the NASDAQ in descending order, into the tariff deadline April 2nd on Wednesday. With the JPM long put in play for Monday at 55.65, this matters because it sharply increases the gamma at that strike and makes the roll more impactful for Monday. We'll be operating from the assumption that dealers will be supporting the market under 55.65 with hedges designed to expire the put worthless. With the New York FANG components, 10 stocks at support that we've seen previously to begin the month of March, we'll be watching how this plays out on Monday as well, with MACD, stochastics, and RSI all pointing lower, along with that bearish price action to end the week. All of this, of course, assumes that the markets are going to bounce on Monday near that JPM collar strike at 55.65. The New York Stock Exchange high-low is negative and bearish at the moment, with the index sitting right on top of the 200-day moving average. Let's say the markets do not bounce and we get a negative reaction on the April 2nd deadline for Trump tariffs. There's potential for the 10-year yield to weaken further by design and for bonds to move higher, with yields reverting back above the zero line like they did back in 2000 and 2007, of course, which led to bear markets, with gold trending, showing safety and concern for the markets right now are heightened. A bullish trend persists. In addition, the ARCA Institutional Index, XII, got rejected at the 200-day moving average last week on Tuesday, pulled back. These are the 75 stocks most commonly held in institutions' core portfolios, so it does appear that they have been taking some risk off the table and hedging going into the Trump tariff deadline on Wednesday. If the worst condition does happen and the markets start to show more weakness, we would likely see IEF, the Treasury bonds, continue to rally, along with strength in gold. Sectors have all been moving lower last week, with the exception of energy, consumer staples, healthcare, and utilities, managing to hold up a little bit better, while the ratio between consumer discretionary and consumer staples continues to give us a bearish signal, telling us that institutions are positioned and hedged for potential downside risk at the present time. With 14 bearish indicators and 4 neutral, only 2 bullish to start the week, we'll be looking at these stocks showing relative strength from the sectors that we just previously mentioned, signaling we should be cautious to start the week. With Trump tariffs affecting cars at the present time, we've seen used car parts suppliers like Orly Automotive moving higher, along with some strength in Carvana and CarMax. With volume increasing, RSI rising, MACD and stochastics turning up. Look for rejection at the 200-day moving average initially, but this strength most likely will persist unless international countries capitulate on the 25% tariffs that were imposed last week. In addition, some of the healthcare names also rose last week, like Abbott Labs moving back above the 50-day moving average, 50-day up and to the right, along with healthcare providers like Cardinal Health, continues this bullish trend, 50 days up and to the right, along with the 200-day moving average. Gilead also continuing the trend that started earlier in the year. February breakout. We came back and retested the 50-day zone. Volume picking up. MACD and stochastics rising. Many of these defensive sectors continue to see a bid as price action moves higher. We also saw many consumer staple stocks like Mondelez moving higher, back above the 200-day moving average on volume as institutions position into these consumer staples names, along with Tyson Foods testing previous highs, RSI rising, MACD and stochastics turning up, along with strength in some energy names like ExxonMobil continues this path higher once it got above the 200-day a couple of weeks ago. While all of these stocks tell you to be more cautious going into this week. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com on March the 30th, 2025, with your weekend video newsletter. I'll send out a watch list later tonight around 12 midnight on the East Coast, around 9 o'clock on the West Coast. So be sure to check your inbox for that. Otherwise, just keep in mind that I'm very cautious. Not going to put a lot of money to work this week until we see what happens with that JP Morgan collar and how the markets react. So that's it for this weekend. Enjoy the rest of it. Take care.